Assalamualaikum and good afternoon to our esteemed guests, ICDM members, ladies and gentlemen. We're going to start now. My name is Khadija from the Institute of Corporate Directors Malaysia, ICDM, and I will be your host for the Power Talk this afternoon. Thank you for making the time out of our busy schedule to attend our Power Talk. Before we begin, just a reminder to please feel free to type your comments in the chat box and also your questions in the Q&A box. And also feel free to upvote the questions that you think are interesting and should be addressed by our speakers today. The Power Talk by ICDM is a platform for inspiring conversation around local, regional, and global board effectiveness. The series of talks aim to create an environment where directors from diverse backgrounds can exchange ideas, share insights, and discover new perspectives that can lead to actionable outcomes that help shape the future. For our 12th edition of Power Talk, we have the fortune of sharing the insights of our speaker, Mr. Rakyat and Dr. Jit Singh, who will share on the facts and targeted incentives, as well as economic measures of the largest budget in Malaysian history, focusing on three fundamental trusts: the Rakyat prosperity, business continuity, and economic resilience. We will have a spotlight session on Budget 21, followed by a panel conversation with Dr. Jit and a Q&A at the end of the session. To open our Power Talk today, I would like to invite our ICDM's very own president, Michelle Kaitini, to give a welcoming remark.
Thank you, Khadija. Afternoon, everyone. Distinguished guests, ladies and gentlemen, good afternoon. Welcome to today's Power Talk. We are extremely honored to have both Bernard as well as Dr. Jit, who is our member, here with us, to offer their thoughts on the recently announced 2021 budget, as well as to go through the highlights that are crucial for boards and directors to take note of. Now, as the National Institute of Directors for Malaysia, we do work as a partner to boards and directors by anticipating your challenges and offering solutions that would help you stay one step ahead. We also do help advocate on issues affecting the director community. Now, 2020, as we all know, has been a very challenging year for all of us, for all communities and businesses. And we certainly hope that the coming year will be a better year for all of us. Now, the 2021 budget is the largest in the history of Malaysia thus far, and it is very much centered on the people or the Rakyat's well-being, whilst investing in key pillars to stimulate economic activity, creating and safeguarding existing jobs, and caring for the underserved communities. Now, for companies, it is a critical time to balance the financial and social obligations to ensure the sustainability of businesses. Now, it is also an opportunity for companies to complement the government's efforts in supporting the economic recovery, as well as the Rakyat's well-being. Boards and directors in particular are expected to rise to the occasion to help companies improve financial strength and stability by focusing on growth opportunities or capital that will enable growth, now such as human capital, talent, technology, capacity building, brand building, infrastructure, and new product lines. Now, on that note, we are also pleased to announce that we have been working on a Power Talk Global series themed 2021 Refresh the Agenda. Now, this will take place early next month and is aimed at providing boards and directors a head start on their priorities in charting a new course for the coming year. Now, do look out as we announce the topics and a new lineup of global speakers. You can also reach out to any of us for more details after this session. Now, without further ado, let's begin today's Power Talk. Once again, thank you for joining us, and I wish you a very productive session ahead. Thank you. Thanks, DJ.
Thank you, Michelle. Thank you so much, Michelle, for the welcoming speech. As I'm sure everyone's eager to hear from our esteemed speakers. Without further ado, allow me to introduce Dr. Jit, a non-executive chairman of Tricorp Services Malaysia and president of the Malaysian Institute of Accountants, MIA. Dr. Jit has over 30 years of diverse experience in the field of accounting, taxation, and commerce, and also sits on the board of embarks Malaysia Berhad and UNW Holding Group. Please welcome Dr. Jit to set the context for our Power Talk today.
Thank you. Thank you for the introduction, and thank you to ICDM as well for inviting me to share some thoughts on this. Now, as mentioned, I'm just going to go through some backdrop in terms of the budget and kind of context setting, and then before Bernard Yap covers the specific details. So let me just take you through some of these slides that I have on a macro view. Okay, next. Now this is basically the various issues that we face or have faced and will face, and some are current. COVID-19 impact, obviously all of us know that's really the fundamental issue that is at hand. There is, of course, the usual element of political uncertainty that keeps popping up, but we'll survive through it anyway. Dependence on unskilled foreign labor, ongoing issue. The US-China trade war, all about opportunities, and the challenging economic environment, which is not unique to us, it's all around the world. And then, in addition, there is a slow pace of technology automation and technology adoption, which has been an issue that Malaysia has to overcome. So this is basically the backdrop that we have in terms of the budget. Next slide. Now, this was the theme. Obviously, rightly so, stand united, we shall prevail, given the context of the epidemic and the pandemic and whatever you will call it. The three key areas around the theme are the well-being, the business continuity, and economic resilience of the economy and the people. Next. Then we find that along this theme that we had and strategies, there were a number of things on the first one, Rakyat's well-being. Obviously, there's a pandemic and public health issues, and therefore allocations. Safeguarding the welfare of vulnerable groups, that's a given. We have to do that. Generating and retaining jobs. That's a bit of a challenge. Some measures have been announced, but will it actually translate is a challenge into actual jobs. Prioritizing inclusiveness agenda has always been there, and of course, ensuring the well-being of Rakyat in terms of helping to cope with the current issues in terms of cash flow and so on. Next is the business continuity strategy. And this was really about driving investment and then as well as trying to attract foreign investment, prioritizing automation and so on, and strengthening various key sectors. And of course, enhancing access to financing. The third one is on economic resilience. And here we use the word expansionary budget, and that's given that in any downturn that you have, in any time the economy is not doing well, government steps in to pump prime the economy, to churn the economy, to do a lot more infrastructure projects because of the spin-off effect. So this is no different. We have an expansionary budget, and we have a development agenda that was mentioned, and this will be unveiled in detail, I think, first quarter of next year in terms of the 12th Malaysia Plan. And of course, enhancing the role of GLCs in civil society was also focused on how, and this is the time when, because of the government's, in a way, control over GLCs, they can drive the GLCs to do certain things to create opportunities and jobs, or maybe temporary jobs and so on. So that's where it comes in. So the issue of talking about GLCs per se is a separate item that one can always talk about, but fundamentally, given the economic situation, the government has to look at how to use GLCs, ensuring resource sustainability. Obviously, this year we saw a little bit more focus on the SDG, Sustainability Development Goals, but very short in terms of detail. So I think we'll again see this in the 12th Malaysia Plan. And finally, there's always a mention of civil service and so on in terms of giving them some support. Next. Now, quick economic indicators at a glance for 2020. And this is projected as at the end of this year. Revenue that the government envisages is lower than expected, 227 billion. GDP growth rate, minus 4.5%. It could well be -3 or -3.5. We'll have to wait and see. Fiscal deficit this year has shot up to -6%. Now, this is largely because of the fiscal stimulus, the Penjana packages, and that were already announced earlier, and that added to the 2020 expenditure. And therefore, that's why fiscal deficit is much higher than previously unveiled at last year's budget. And of course, global economic growth is minus 4.4%. Now, next slide will show you the 2021 economic indicators. Total revenue expected to increase to 236.9 billion. So some of us obviously look at, is this a realistic proposition? We can talk about it later in the Q&A. The GDP growth rate, 6.5 to 7.5%, in line with IMF, World Bank predictions and so on. But to many, it could be overly optimistic because we are uncertain about how quickly we'll come out of this CMCO and the various ensuing impact that we have of the pandemic. Fiscal deficit next year is still minus 5.4, given the additional expenditure that the government has to put in. And of course, global economic growth next year is 5.2%. Next. Now, this is just quick charts, and I'm not going to go into detail. It's to show you just the flow in terms of 2018 to 2021, the revenue. As you see, revenue took a hit in 2020 and is slowly trying to recover in 2021. Budget allocation, if you look at it in 2019, we actually had a 315 billion budget. In 2020, 314.7, largely because it was less, but because of the additional expenditure under the Penjana package and the other economic stimulus package has gone up to 314, and obviously 2021 is 322. So I think the challenge is that we keep saying this is the largest budget ever, but I think generally speaking, in every economic cycle, every year, the budget should keep increasing. If you are looking at a developing nation, you have to keep churning it. So I think it's 2022 is pretty okay. It's just a question of how this will be spent. Budget deficit, as you can see, is going up, and we then need to look at long-term sustainability as well. Next. Now, GDP growth, I think you're well aware, as I've mentioned, a V shape, and we hope this will continue in that manner. Operating development expenditure, as you can see, our development expenditure, the second line at the bottom there, is actually increasing, and that's logical because government needs to pump prime during these times. Next. This is a snapshot of the revenue expenditure, or rather revenue expected by the federal government. And I'd just like to draw attention, and we can always discuss this later in the chat, on the corporate income tax increase. 2021 compared to what is expected in 2020. We are looking at almost a 5 billion additional revenue from corporate income taxes. Look down at individual income tax. We are expecting 42 next year and 35.9 or 36 billion this year. So we're looking at almost a 6 billion increase, and that's interesting. Petroleum income tax, as you know, in 2020, because of petroleum prices went way down to 8.5 billion compared to 2019. And we are expecting it to move to 13 billion 2021. Is that realistic? And all depends on where oil prices move. So the rest of the data in terms of the indirect taxes is pretty much stable. So we're not expecting that very much growth in terms of revenue, a little bit here and there, but the challenge is income tax revenue. How is that going to be churned out? And are we overly optimistic as well, given that we also optimistic about growth rates? So are we optimistic about revenue growth rates as well? I just want to also draw attention to the non-tax revenue, last item at the bottom before the total column. And we are expecting 62.5 billion in terms of non-tax revenue. This is where the Petronas dividends come in and so on and so forth. And this year we expect 74. So a 12 billion drop expected next year, and therefore that needs to be covered by income taxes and so on. Next. This is a quick analysis. We say it's the largest budget in Malaysian history, but I think it's logical. As we keep growing, we need our size of the budget will keep increasing. There is a COVID-19 fund that was mentioned, allocation of 17 billion. No real details about it in terms of the components. We saw that the expected revenue versus operating and development expenditure Again, if you look at its revenue growth, this is only expected to be enough to cover operating expenditure. So all the development expenditure and the COVID-19 fund allocation is financed by debt. And the debt ceiling raised from 55 to 60 by Parliament recently, part of the measures to try to mitigate the fallout due to the pandemic. And of course, GDP growth rate, the issue is it a realistic growth rate? Only time will tell. Next. Now, a quick snapshot of the highlights that will be covered in some way by Bernard in the context of the time we have. There's special incentive package for high value added technology, 1 billion, and that's to be expected. The comprehensive study of existing tax incentives was mentioned, but this is actually a carry forward from 2020 because this is also mentioned in the 2020 budget. We were expecting that this would be ready this year, but unfortunately, because of the pandemic, things got postponed. So we think this will probably materialize end of 2021 or maybe even early 2022. There's a tax incentive for non-resource-based R&D product commercialization activities. There's a focus on digital economy, which is realistic. There's an extension of tax incentives from Jana, and there's also this pharmaceutical manufacturers we are trying to attract by giving them a 0 to 10% tax rate. A new term called Global Trading Center has been announced, and that's a tax incentive of 10% for 5 years plus another 5 years. Details are forthcoming. Principal hub incentive that currently exists extended for 2 years. And of course, for individuals, there's an increased personal tax relief. And maybe we'll talk a little bit more about that later after Bernard's presentation. Next, we conclude with the challenges and the concerns. Obviously, the socio-economic impact of COVID-19. The issue is this so simple as saying the next year everything will be fine? And I think we need to be aware that it may not be as fine as we envisage. So let's just see how things go. We just have to take care and see what we can do. And that's why it could well be that 2021 will still be impacted, and 2022 we might see improvement. So there's a challenging economic climate out there, and again, lots of uncertainty. So this provides challenges for businesses, for boards, in terms of how we're going to do things going forward. The other item here is the efficiency and effective distribution of funds. Now, as always, lots of funds, lots of allocations, and to us is always the cost-benefit analysis. Is this going to where we want it to go, and is it being spent effectively? So value for money issues are always there. Trade war implications continues to be on the radar. The other point is whether the tax incentives that were announced in this particular budget will be beneficial in the long run. Will it really attract foreign investment? And that's a challenge given the environment we are in. The other concern is high level of national debt. I think we can live with national debt being increased, but we need to look at reducing it going forward. And of course, attracting high value FDIs has always been our interest, but sometimes we give way to continuing to give incentives to labor intensive investments as well. So we need to be very, very clear about what we want. Uncertain political situation, I think that's clear. And of course, upskilling of workers, that's crucial for an economy that wants to move into the upper income levels that we all aspire to. So I think that's the slides that I had in terms of at least setting the context of how this budget was crafted, and perhaps the challenges. And with that, I would like to pass it on to Bernard for the detailed presentation on some of the specific measures. Thank you.
Thank you very much, Dr. Veer, for setting up the economic context, quick analysis of the budget 21, as well as highlighting the importance of balancing between optimism and realistic expectation of country's growth. Let us dive deeper into the key highlights of the budget 21 with our next speaker, Mr. Bernard Liang. Just a quick introduction to Mr. Bernard. He is the head of private client services and financial services within the tax practice in Malaysia. Was also the indirect tax lead of EY that led the GST implementation in Malaysia, and has been actively involved in compliance, regulatory, and consultancy engagement from Malaysian financial institutions, including Islamic financial institutions, such as setting up an in-house tax department from Malaysia's largest Islamic bank, amongst other achievements. Over to you, Mr. Penny.
Thank you, Khatijah. Afternoon, everyone. Thank you for the introduction. Do bear with me. I'm trying to put my slides up now, and hopefully everybody can see it in the next few seconds. Okay. So good afternoon again, everyone. Firstly, thank you to ICDM for having myself and representing Ernst & Young on this session. And it's also every time great to be sharing a session and a panel with Dr. Verinder, our tax guru in Malaysia. So without further ado, I think Dr. V has covered this quite very well in terms of the overall objective of the budget. And I think my adding on to a few points here, I think it's very much focused on what I call it the message of now, next, and beyond, where the budget is very much focused in terms of making sure businesses and the people on the street are able to pass and recover from this pandemic. And then the next thing is obviously then looking at the next stage where we should need to move forward, improve ourselves to make sure that we are becoming more efficient and more relevant post the pandemic. Obviously, the ongoing measures that were introduced in some of these stimulus packages continue to be extended in this coming budget. And I think we're going to see more of this in year 2021 as well. So what I'm going to do here, I've broken up into two major forums. In terms of the first one, it will be on the top corporate tax proposals. I've got about 6 or 7 here, and then to share with everyone what can we do to make sure that we're able to sustain past the current situation. And the next one after that would be on the personal income tax introduction. So the first thing we go into, this is on transfer pricing, very new coming into the legislation. This was not announced in the budget speech. There is now going to be specific penalty if any of the corporate entities that has got related party transactions where they failed to furnish the transfer pricing documentation as demanded by the Inland Revenue, there will now be penalties. In the past, just to share with you, in the past, during audits, Inland Revenue will give between 2 to 3 months for companies to prepare transfer pricing documentation if they were not readily available. At the moment, the experience we see is that IRB will now tend to give you between 2 weeks to 4 weeks to get ready for the documentation. So that's cutting short in terms of the time frame that's available for corporate taxpayers to furnish their transfer pricing documentation. The second one is in the current situation, the Inland Revenue is permitted to disregard certain related party transactions if they are of the view that they are tax evasion. However, now moving forward, the DG is allowed to make adjustments to certain part of the structure or certain part of the transaction that it deems fit. So instead of ignoring the total transaction altogether and having a huge tax impact to the taxpayer, it may be allowed now to make certain adjustments to it. So for instance, if a certain interest rate that is charged between related parties is too high, previously Inland Revenue will ignore it and completely ignore it. And now they can deem fit and adjust it to maybe the market rate or the prevailing interest based lending rate. This is quite unique, the next one that is being introduced. In terms of failure to comply with the transfer pricing requirements, not only that Inland Revenue today imposes penalty, but what they're going to do add on now is that they have the authority now to also impose surcharge to the amount of the tax that they can recover. This is not new. This is something that has also been introduced in our neighboring countries in ASEAN. So Singapore, Indonesia, and Thailand are some of the countries that have also introduced this surcharge at the recent budget that they have introduced. So what it means to us is basically they are now, Inland Revenue is now tightening up and reviewing transfer pricing. If you know any of the audits that you have gone through, a lot of the general questions and the standard questions being asked is very much focused on transfer pricing, and failure to adopt any of the transfer pricing requirements or even produce the transfer pricing documentation has automatically resulted in disallowance of the transaction. And even worse is that a lot of the adjustments are very arbitrary in that respect. Next one under the introduction, and this is also again in the finance bill, not announced in the speech, which is in the past where any tax that is payable, it is always paid to the Inland Revenue within 30 days from the issuance of the notice of assessment. Taxpayers, if they feel aggrieved in terms of the treatment by the Inland Revenue, can actually apply to High Court and seek a judicial review and ask for a stay of payment. And in a lot of the cases recently, it has been issued in the favor of the taxpayers, where the High Court has agreed to have a stay of payment whilst the taxpayer actually proceed to have the case to be heard as Special Commissioner for a review. So what they've done is, given that Inland Revenue has been losing all these cases, they've decided now to change the law, that notwithstanding that you want to appeal for the stay of order, they've now specifically said that any proceedings under written law shall not relieve the taxpayer from paying the tax liability that is due. So that's quite common. I guess Dr. V will also be able to share later. That's quite common that a lot of times when case law decisions have not been in favor of Inland Revenue, they've come in and just amend the provisions of the Income Tax Act in the subsequent budget. The next one is on the group relief, tightening the group relief procedures. This has been quite ongoing in the last few budgets that has been ongoing. We see that now the group relief is now even more restrictive to ensure that the companies, both the surrendering and the receiving company for the group relief losses, must be resident and incorporated in Malaysia. That includes also the shareholders of both the entities. So in certain circumstances, we may have an intermediate holding company in between that could be foreign, but ultimately still owned by a Malaysian company. However, that is not going to be permitted moving forward. The good news about this is that the effective date is actually going to be from YA 2022 onwards, which means that you have approximately 12 to 13 months to restructure in the event either your claimant or the surrendering company is not actually 100% owned by a Malaysian entity. Okay. Dr. V touched a bit on Principal Hub. So the Principal Hub is actually not new to the Malaysian incentive environment. It has been in existence for the last 5 to 7 years. The most important part here is that they have now extended this incentive until 31st December 2020. However, specifically, they have excluded now the trading activities. And the main reason for excluding the trading activities is because under the next slide I'm going to show is that they've introduced a new incentive called the Global Trading Center. What's the difference between the Global Trading Center and the Principal Hub? Is very much in terms of the activities that they can undertake. One's on a buy-sell activity, the other one's on more of a service entity. The tax rate is also going to be at a preferential rate of 10% for 5 years, depending on how much of the commitment that you've done over the first 5 years. And also in terms of the activities that have been carried out, it can be extended for another 5 years. We had a session with the MIDA representatives yesterday in the EY budget seminar. The representatives there have also acknowledged that it's quite challenging at the moment to introduce this Global Trading Center incentive in Malaysia because of the fact that the prerogative and the main criteria that they're looking at is actually having new entities transferring their trading operations from outside Malaysia into Malaysia. They are not encouraging local entities that already have existing trading activities in Malaysia to come and apply for it, because given that you have already continued to be operational here in Malaysia, the question is whether should we extend the incentive to the existing entities. So it's a very snapshot look at in terms of how we differentiate between a Principal Hub and a Global Trading Center. So a Principal Hub on the left is mostly on a service model, which means that you are providing all the support services to your group of companies undertaking manufacturing and trading activities. Whilst on the right-hand side, you would have a center here based in Malaysia to undertake all the trading activities. You do all the buy-sell activities here in Malaysia. The coverage of financing, insurance are all undertaken through the GTC here in Malaysia. So difference here purely, if I look at it and summarize, is purely between a service model and a buy-sell trading model. The next one is the extension of the current incentives that we have under Penjana. This is very much in terms of where the Malaysian government is trying to encourage operations to be transferred into Malaysia. You are aware that we are having through the trade war between US and China. I'm not sure whether that will continue with the new president coming in, but obviously because of the current trade war and a lot of the operations, the manufacturing activities out of China are seen to be exiting China, and a lot of these activities have already transformed into the current region in ASEAN. Cambodia and Vietnam has also been one of the largest recipients of these activities coming in. So Malaysian government is not doing any different. They're also extending incentives to encourage them to set up their operations here in Malaysia. And these incentives now would actually be available. So what it is going to be is that it's going to be extended further in terms of in line with our Malaysian Industrial Revolution 4.1 and also in terms of digitalization. So what they've now in the 2021 budget have extended it to the following activities of technology solutions, infrastructure and technology for cloud computing, R&D activities, as what Dr. Brinda has also mentioned earlier, medical devices, and also any other specific manufacturing related services that they think are high-end and also they think that are pertinent to the growth of the Malaysian economy as well. So this is more of a special case that will be approved by the Minister of Finance himself. This is for a period of 10 years, and its rate will be between 0 to 10% depending on the criteria that you meet, or otherwise in terms of existing companies bringing in new activities coming into Malaysia, you would have at 10% preferential tax rate. Other tax proposals, in terms of the first one that is on the definition of plant for capital allowances purposes. Capital allowances is basically our tax depreciation, and what they've now done is restrict the definition of plant to exclude buildings, intangible assets, which are mostly software, which is quite surprising because as the slide before, Malaysian government is trying to promote digitalization and industrialization of 4.0. Here we are trying to exclude software and intangible asset as a plant, and it's very detrimental in terms of whether we can now claim capital allowances on software moving forward. Obviously, the next one is in terms of any asset that is used and the function as a place for where the business is carried on. So again, similarly to building, they're going to exclude it. So previously, a lot of the special purpose buildings that were designed for your business under case law, they have been able to claim capital allowances. Moving forward, I think this is going to be more challenging. In terms of REIT, they now treat that any withholding tax on REIT will be a final tax and therefore simplify in terms of the tax returns that the unit holders will actually be required to submit. The next one is a couple of extension of time that granted to Labuan entities to make the irrevocable election, whether they want to be taxed under the Labuan business tax regime or under the current Malaysian income tax onshore regime. That's the extension of time to be given to the Labuan entities if they're still unable to make the decision. This one is a very quick snapshot. A lot of the current existing incentives that we have were supposed to expire in 2020 have now been granted extension until 2022 on the left-hand side, and certain incentives that I think the government still finds important have been extended until 2025. In last year's budget, and also mentioned by Dr. Virinda, a lot of the current review of our tax incentive and the whole entire Malaysian incentives framework is still ongoing. Hence, I think that's why the government has decided to extend it for another couple of years, pending what the final framework of incentives is going to be reintroduced into the Malaysian environment. So what can we do about it? Obviously, I mentioned about digitalization and technology. How fast can we adopt it to make sure that we are ready for it? There is a Bank Pembangunan fund that is going to be made available, so corporate taxpayers can actually apply for it. Whilst you're upgrading your process and your technology to be in place, you also need to reskill and upskill your employees. So look at all those programs that are available from HRDF and MDAC that is currently available as grants for you to retrain your employees. The same also looking at new graduates and training programs that can be available from My Apprentice program under Penjana, and normally a lot of this is also managed by Talent Corp. Looking at also the people on the street, as much as whether we can look at employing the senior citizens, some ex-convicts, parolees, supervised persons. These will give you incentives, double deduction in terms of hiring these people coming into your workforce. Earlier mentioned about relocating manufacturing of facilities. Existing entities can apply for investment tax allowance. Technology comes into play in terms of building, applying for industrialized building system to be able to be more efficient in terms of the way we structure our business. And because of liquidity, the situation we're in, you may also consider looking at certain type of SRI and green bonds in order to be able to sustain and finance your current business operations. So this is where quick shot of the applicable measures that have been introduced under the budget 2021 for corporate. So I'm quickly going to go through. The next one will be on individual tax proposals. The focus is very much on these three objectives. The first one is obviously making sure that the financial burden of the individual is very much focused on it. How do we then manage the unemployment current situation that we are facing in Malaysia? And the third one is also looking very much at the resilience. How do we then make sure that we can come out of this resilience, this pandemic, and be resilient? And then after that, let us regroup and regrow again after that. So the government heard in terms of the situation where we're in. We have seen reduction of individual income tax rates over the last two budgets. So this year is very much focused on the bandwidth between 50,000 to 70,000, a further reduction of the tax rate. This will give back approximately 200 ringgit to the individuals in the bandwidth. While we said 200 may not be in importance of some people, but 200 for the people on the street will be becoming very important in terms of their day-to-day lives. Existing reliefs has also been extended. So we know that currently we have a 7,000 ringgit personal relief on individual undertaking education to upskill themselves. So what has happened now is that they have now included and expanded the technical education fees to be including where we take up certain upskilling and self-enhancement courses, as long as, my apologies, as long as it is recognized by the HRDF and also the Ministry of Human Resources. This has now been extended by limiting it to 1,000 ringgit per annum. We've got a lifestyle tax relief introduced last year for 2,500. It's now been proposed to increase by another 500 ringgit to 3,000 per annum. And this is to be given for you to purchase any sports equipment. If you do any rental, such as your futsal court, badminton court, and if you do participate in any competition, that's available now as a relief. It's also available in terms of subscription of electronic newspapers as we go digital nowadays. The next one is obviously on the EPF contribution. They have now recommended for the EPF contribution to be reduced from 11% to 9% for the year 2021. However, if any employees would like to continue to maintain their existing contribution rate of 11%, they can still write to your HR department and ensure that they continue to remain at 11%. So it's an option that's still going to be available for all employees. The wage subsidy program that is available in terms of it, it's now been given for additional 3 months for specifically for the tourism industry. Previously, the wage subsidy program would have expired by September and it's been extended to 2020 December. What they've done now here is to reintroduce it to be extended to the tourism industry. It's going to be capped to approximately 500 employees per application. Previously, it was only to 200 employees. So again, this is very much focused and very much designated to the tourism industry that has suffered significantly under this pandemic issue. In terms of the Malaysians Returning Expert Program, they have now been extended for another 2 years to 2023. The incentive is at the moment at a flat rate of 15% for returning Malaysians. The next exemption, duty exemption on the cars that they can purchase, it is still going to be there until 2023, but the amount to be qualifying for the exemption has been reduced from 150,000 ringgit to 100,000 ringgit. The application has to be submitted to Talent Corp, which will be the main regulator to process these applications. In terms of companies that are able to relocate their operations to Malaysia, any of them who are non-Malaysians holding key positions in these companies will also be available to enjoy preferential tax rate of 15% flat across all their income, right? The conditions here would be that it's only available for the next 5 consecutive years once the application has been approved, only given to 5 non-Malaysian employees, and you're looking at individuals must earn salary not less than 25,000, and obviously you have to be a tax resident for those years. Other tax proposals for individuals that we have here is that you can see here the tax relief for medical has been increased from 6,000 to 8,000 ringgit, and it's also available for medical checkup that you plan to undertake. It has also been increased from 500 ringgit to 1,000 ringgit. In terms of medical expenses for serious disease, it has also been available now for up to 1,000 ringgit per annum. I guess we'll just have to wait for the Gazette order to come out to define what serious disease it's going to be. And normally RV will actually be quite good in terms of explaining it, and you would have it in your explanatory notes in your individual tax filing. In terms of tax relief and exemption, especially on medical expenses incurred for parents, it has been increased from 5,000 ringgit to 8,000 ringgit. For disabled spouse, it has been increased from 3,500 to 5,000 ringgit. And the next one is for the loss of employment. It has been increased temporarily for 10,000 to 20,000 ringgit, only for specifically only for the year 2020 and 2021. What else do we have here? We've got tax reliefs given for the PRS and also the scheme Simpanan Pendidikan Nasional that has been extended until 2025. In terms now, there's a very new introduction of a tax deduction for Amanah Saham Nasional Berhad into the contribution into the tabung wakaf. That's going to be allowed as a tax deduction. The next one is, if any one of the individual investors are keen to participate in equity crowdfunding, you would now be able to obtain exemption of up to 50% of the amount invested in ECF. Very much like the venture cap that's available to companies, they've now extended this incentive to equity crowdfunding as well. There are some conditions to it. It's only limited to 10% of the total aggregate taxable income of the individuals. The investments must be made between January 2021 to December 2023. And obviously, certain conditions will be issued by the ministry subject to their approval. So that's a quick wrap up in terms for individuals tax that are announced in the budget 2021. The next couple of slides that I'm going to go through is very much on indirect tax and also on stamp duty. The first one would be on indirect tax. There is now been allowed increase in terms of the threshold available for annual sales value. That's increased from 10% to 40% undertaking value activities in free zone and also licensed manufacturing warehouse. That's very good because I think this restrictive of 10% has always been complained by the participants and always been made submissions to the customs for them to increase it. The next one is obviously on the authorized economic operator, which is currently a facility that has already been in place in Malaysia customs environment, where it's get the approval is granted. Once you get the approval, a lot of the relaxation of customs facilities, documentation, supervision, audits have been more relaxed by the customs. Under this budget speech, they have also proposed for the AEO facility to be extended to logistics and also warehouse operators. I guess this will be more challenging from customs perspective because of the extent of goods coming in and out. especially on transshipment goods coming in and out of these licensed warehouse operators, and they have to make sure that the documentation are readily available, given that there could be reduced focus on audits and also supervision. Those are enjoying cigarettes. You're not going to hear, you're not going to be liking me too much because I'm going to announce some very negative news here. One of them is that cigarette and tobacco products will no longer be available at duty-free islands. So it's going to be all chargeable to duties moving forward from 2021 onwards. No new licenses will be issued for the trading of cigarettes. And also in terms of importation of cigarettes into Malaysia will be now tightened, and also very much focused on certain ports that will be allowed to import and export cigarette products. E-cigarettes will be treated the same as normal tobacco products, and they will be subject to excise duty. And that excise duty is obviously very much focused in terms of the way the consumption of the e-cigarettes is at 40 cents per milliliter, as vis-a-vis to the weightage of the tobacco products. The next one is actually where we have the tourism tax. Previously, in terms of tourism tax, was on only on hotels. Now it's been extended for accommodation that are available, that is on online platform operator, something like very similar to your Airbnb operators. That's going to be effective only from 1st July 2021 onwards. The next one would be on stamp duty. The current stamp duty exemption available on insurance policies and takaful certificates for perlindungan tenang will now be extended until 2025. The other one as well is to give more encouragement to abandoned housing projects. Any of the banks undertaking these projects, the loan agreements will now be exempted from stamp duty. Also, any new buyers coming into these abandoned housing projects will also be exempted from stamp duty on the SPA agreement. In terms of also trying to promote the ownership of first home, what they've done now is that the instruments of transfer for the SPA and also the loan agreement for the first residential property will now be given exemption for stamp duty until 2025, up to the value of 500,000 ringgit. So that's the stamp duty exemption available that has been granted by the Ministry of Finance in the budget 2021. So with that, I'm going to pass it back to the MC for the next session on our chat. Thank you.
Thank you, Bernard, for the succinct presentation and actually highlighting some of the opportunities that businesses should take advantage of where possible, what we should be doing in this context. Let me just spend a few minutes just giving some quick overall comments, and then maybe we have a couple of questions, and then we'll address some of the questions that are coming in through the Q&A chat box. Now, one of the challenges we have is that the expectation is that the government can spend a lot more than it has. And I think we need to be very, very mindful of the fact that we cannot compare ourselves with Singapore because Singapore has surplus budgets in the past, and there's a lot of money in the kitty, and that's why they can spend so much more in terms of helping the Rakyat, spending a lot more on COVID-19 and so on. Whereas the amount that we are spending is a bit limited. When you look at the population size, it does put us into a situation where we are spending so much less when Singapore is spending so much more. I think that's the challenge we have in terms of our spending and our savings. I think the point that I have made before in other forums is that many of us think that the government owes us a living. And actually, the government fundamentally is supposed to take care of the ecosystem. And then we are supposed to then move along, study, work, earn a living, and do whatever we can to survive. So we are not a welfare economy. And therefore, we tend to forget that. And if you compare ourselves to the developed world, we don't have that kind of reach. So that's why what the pandemic tells us very clearly is savings is absolutely crucial. So we should all be having a look, one eye on the savings besides spending. and making sure that the savings are there in our reserves so that we can dip into it for this particular situation. The other comment is really that this budget, if you were excluding the fact that of the pandemic, and if we exclude the fact that this is now almost the third year in the cycle of the current government, this will be clearly seen as an election budget. But we all know that this is coming in because of the pandemic, so we appreciate it. But there are a lot of one-off payments here and there for some sectors of the economy, like civil service, which I think many felt that it could have been best channeled to help the deserving, the poor, and those who have lost their jobs. You could actually spend it more and then give rewards to the civil service later, because the important point is we should be helping those who have lost their jobs or who've had their jobs curtailed, and rather than helping those who already have their jobs in place. So that's one of the challenges that we have to do. So when you give away one-off payments, which equivalent to treat it as a bonus, to me was unnecessary. It's money that is going in the wrong direction. The other aspect is that we have lots of underlying structural issues in the economy, and that impacts us also, those of us who are running our businesses or companies. The issues that we have in terms of the education sector, the foreign worker issues, the migrant economy in terms of unlicensed or illegal workers, the sustainable tax structure is also another underlying structural weakness. But I think we'll see more of that when the 12th Malaysia Plan comes about. The other interesting thing is that the challenge is there is nothing specific in terms of streamlining the public delivery system. How to make licensing easier, how to make it easier for people to start a business instead of going through so many channels. You know, we seem to score well in various types of surveys. But when you look at doing business in Malaysia, there are still areas that we should be able to cut down on in terms of paperwork and so on and so forth. So that's a bit missing. And of course, technology can be used better. And I think in the end of the day, it could be that if the government had introduced a phased reduction of corporate income tax across the board, ultimately to reach a 20% tax rate, that would have probably been seen as even better. But I think the challenge is when you lower tax rates, you worry about revenue loss, and you're not sure whether you can recoup it. So this is a dilemma that we all face. The cigarettes, excise duty on cigarettes is something that is a no-brainer. But then you find that the budget, or rather certain agencies, those who run budget hotels now in Langkawi and all that, have been objecting because they seem to say they make a lot of money out of this. And I wonder myself, how do they make a lot of money? This thing, many years ago, I was also involved in various discussions with the relevant authorities. And I'm also as a member of the Tax Reform Committee of the Ministry of Finance. And it's a no-brainer to say that one of the suggestions that we've been making all this while is do away with this duty-free status on all our duty-free islands. And because there's a lot of abuse when it comes to cigarettes and liquor. I mean, it's going in there as if it's duty-free, and it's coming out and being actually consumed in the domestic economy. So those are challenges. Now, I have said before that I think we might see that this particular issue of fiscal duty, or rather excise duty imposed on cigarettes on duty-free islands, may not turn out to be what it is. And because political will is important, and I think let's wait and see whether this really goes in. But personally speaking, that's a very good measure to curtail smuggling, to actually make sure there's less abuse of this particular situation. My other point, of course, was on personal reliefs. Bernard has shared with us the various increases that were introduced, including the lifestyle relief, which was increased by 500 for sports and so on. We tried that before. We've had this increase in personal relief, which are related to sports-related equipment. A few years ago, at that time, the minister was Khairi Jamaluddin. And that subsequently was taken away. It was combined into the lifestyle relief, and now we introduce another 500 for a similar thing under a lifestyle relief. So this is the kind of thing we introduce when we shouldn't be doing that. Yeah, my own take on personal reliefs, Burden may have another view. My own take on personal reliefs is, if we keep increasing personal reliefs, it's fine. It benefits some of us who are in that situation. But remember one thing, 15%, 15% of the workforce is actually paying taxes. The rest are below the threshold. Now, so if you introduce personal reliefs, it benefits 15% of the, in fact, 15% of the workforce is benefited, which is in fact a lower percentage of total population. Is that effective, right? So I thought if you want to help the middle, or let's say the M40 group, giving a special relief one-off for the couple of years, 2020, 21, 2,000, 3,000 special relief would have been the ideal way. And don't touch on all the other personal reliefs. And maybe if we got time, Bernard, we talk about GST and VAT, maybe if you want. And then the issue is how do we move our tax structure forward? The other thing, perhaps, Bernard, my question as well to you for discussion is this thing about increased tax revenue in 2021. If you look at the data, it's projected to increase even more total-wise. Just income tax on corporate and personal income tax. Percentage increase is far more than the projected 6.5 to 7.5% GDP. Now, do you think that's realistic? And how do you think the Inland Revenue Board would be able to generate the amount of additional revenue? I think I know the answers, but maybe I will get Bernard to perhaps give his views. Bernard, over to you.
Thanks, Dr. V. I think this is, you already intentionally put this question to me once you put up the figures of the corporate income tax and the individual income tax. Well, I guess what we've seen during the last 6-7 months of working from home and everything, Inland Revenue has not slowed down in any of the audits and investigation cases. And even more so is that a lot of the cases have been decided by Inland Revenue to quickly wrap up by the year end in order to finalize the cases and collect the taxes. And I think the fact that how much appreciation of all these audits and investigations going on in terms of the technicality of the case, the justifications and everything, has not really been well received by the taxpayers. And I think that's going to, and I see that's going to continue going into 2021. But for individual income tax, because of the information that is now readily available for Ministry of Finance, because of the exchange program with all the tax authorities under the Common Reporting Standard, I think now it gives them additional data as to how a lot of individuals are actually high income earners are maintaining foreign accounts overseas, and how much of the assets, financial assets, are parked overseas. They have now got to come into the Malaysian Income Tax Net and justify how did these financial assets and bank accounts have actually been parked overseas. And does that reflect in terms of the income tax returns that have been filing? I can understand from individuals because these are more additional data that Inland Revenue has been accessible, especially in the last 2 years when CRS has been more operative, and the fact that then they can do data analytics on it. But I think corporate income tax is challenging. As you said, the economic growth and where we are today for 2020 and 2021 is not going to be a great outlook, but you're looking at about, close to about 8-9% of growth in terms of corporate income tax. So I can only see that through enforcement and actually through audits and investigations to be carried out more regularly by Inland Revenue.
Yeah, I think that's exactly the case. So you're going to see a situation that we saw a few years back as well, where aggressive audits and tax bills were being issued, additional taxes on various large corporate players. In terms of, and at one time it was a lot of developers getting a lot of assessments. We're going to see more of that, and that's the danger from a business perspective, that this becomes an unnecessary pain that we go through. And I sit on the board of a large listed conglomerate, and I've already told the finance people, just be prepared for a tax audit. Because we are large and therefore we do pay taxes, but we've all been impacted in some way of this particular with this pandemic. So the challenge for us is that we look at borrowing, we look at revenue, and we project the revenue can be somehow squeezed well over, I think in some cases, if you look at personal and so on, 15% more. And this is actually mind-boggling. How do you do that except with squeezing a lot more out of taxpayers? So that's the challenge, and so businesses need to be aware of it. And I think relevant boards members need to be prepared to ensure that you can face a tax audit successfully. So the other point many have said, and I was in another forum this morning as well, is about the usual question: shouldn't GST be introduced? Or rather, the question was, do you envisage, or when do you think, or will GST be introduced in the near future? And obviously, my answer is yes, it will be in the near future. I can't tell you when, and so on. But Bernard, since you have been active in the past, also on the indirect tax area, perhaps quick comments on that.
I think over time, when because of the change of government and we went back to SST during the last 2 years, a lot of the ministries and the representatives has also acknowledged that GST was actually a much more efficient collection of tax for indirect tax purposes. But I think the other part that is being acknowledged and is very important from the Ministry of Finance is also the fact that GST actually able to bring up a lot of the black economy for which they were always under the radar and could not be seen. And that's effective for both corporate tax and also indirect tax. And I guess as and when you can't take back the credit of GST, and that's why the black economy surfaced and they want to be more relevant. I think at the end of the day, it's a much more efficient system. Obviously, if we cut down in terms of the bureaucracy of abuse and in terms of effective utilization of the additional revenue collected by indirect tax, I think the nation would actually be more acceptable having it back. Obviously, the rate, if you talk about the rate, if we think the rate of 6% is still too high, has inflationary impact, and we can't adjust the pricing, we can start back at a lower rate and then continue to be more effective in terms of implementing. And also actually, in your case, what you said, Dr. V, is that actually a lot of things that we introduced, the biggest challenge is actually how effective of us implementing and actually ensuring that the system works effectively in this situation. I also agree with you. I mean, there's a lot of discussion in terms of when it's going to come back, but that's going to be in your $1 million question.
Yeah. Okay. So I think we all agree, and I've also, I think some of us in various forums have said that GST is a very efficient tax, but it's not the silver bullet, which will just automatically generate billions and billions of revenue. And people seem to forget that. They seem to now argue that GST, by introducing it, automatically you'll produce billions of ringgit, even more than what the SST currently provides or generates. I think the answer really is the scope of the tax are different. And the SST is very narrow in scope, and GST was very wide, but GST also had a long list of exemptions. So that's a topic for another day, and we can always chat about that. The other thing is obviously, do you think that there were a number of new tax incentives? And I just wanted to allude to this because, again, as a former member of the Tax Reform Committee at Ministry of Finance, one of the things we suggested in the past was also, and many others, is that our incentive structure is skewed. It's that we have so many different types of incentives. It's and in fact, our legislation that deals with our incentives, it's so difficult to read nowadays when you look at how it was in the early years. So many changes that were made, complex calculations and so on and so forth. So we said that one of the best ways is to simplify the law. And we didn't see any specific measures, but we heard about the review that probably will come about. And you have any ideas, suggestions, or what you think that review of the tax incentive framework will end up like? And I give you one hint. One is obviously the fact that we have seen, and one of the things that I also myself have suggested was stop introducing special incentive schemes which have different permutations, calculation basis, different treatments, because to do that, you'd introduce more sections in the act. So I've said before, and I think this budget brings it out clearly, is that use the tax rate as the incentive. Just focus on the tax rate. You give a 0 or 5 or 10%, that's the incentive rather than the pioneer status, investment tax allowance, and all these things that we have. Do you think that would therefore be a much neater incentive to enforce? So perhaps, Bernard, just some quick comments, if you have.
Yeah. I know, sort of agree with you, Dr. Brinda, right? I think at the end of the day, the government needs to balance it up. I mean, we're giving too much incentives out, and that's going to impact in terms of the revenue collection and where we are today. And hopefully, yes, if we do give out these kind of incentives in the past, all the multiplier effect in terms of the rejuvenating back the economy, the contribution back to the economy, employment, usage of the local enterprises, enhanced usage of SMEs in Malaysia. Hopefully that really came through in terms of it. But we've seen also a lot of the foreign investors coming in actually use back a lot of the own internal supply chain, if I could put it that way, and doesn't really rely back on a lot of our Malaysian local suppliers. I'm actually also agreeable with the fact that, yes, we don't need to give a 0% exemption all the way. Let's look at more of reduced or preferential rate over a longer period. And that's beneficial to both the taxpayer, the corporate investors, and the government. Government still have some flow of tax revenue coming in, and that's good. And the other part is also longer sustainable period for these taxpayers or corporate players to be in the country. A lot of them we've seen, after giving them 5 years incentive, they shift and move their operations over to a lower jurisdiction, or someone was going to give them another 5 to 10 years tax holiday. It's easy to move just their warehouse or the plant over to, let's say, Vietnam and Cambodia, where we know today they're given at a minimum 10 years exemption. So it's not really sustainable from that perspective.
Okay, so I think that's probably the way we are seeing it. This particular budget, I suppose the most significant thing I see from a point of view incentives is that there is this section 65B of the Act that is now being introduced, which actually gives you the, what they call it, the incentive scheme, under which global trading centers, principal hub, and all this will come under. And that is a section which actually only focuses on the tax rate, pharmaceutical companies, relocating and all that. I think that was a good move to try to make it easier. And this comes under the purview of the Minister of Finance. So it's very interesting that you no longer have MIDA involved, but you have the Minister of Finance and they make the call. So to me, I highlighted it's great to have all this, but to make sure that you have clear criteria, what sectors are you encouraging, have it written out, have it documented so that you don't start abusing that provision where you may just give it to anyone all in sundry. So I think we will see for participants, you will realize that going forward, that's probably how our incentive structure is going to be panning out. We may end up with the tax rates being at different rates rather than having all the complicated pioneer status, investment tax allowance, and so on. We'll have clear criteria that we are looking at certain types of expenditure, certain types of sectors. And the challenge, however, is that going forward, we are looking at what we call the service industry. Nowadays, if you get away from manufacturing, then that issue is relevant because service industry, not so much capital expenditure, but there could be huge amounts of revenue and so on and so forth. So let's look at a few questions that have been put into our chat box. I think in our discussion, we've more or less answered a few. And let me just see, there was some question on the Singapore budget, which had, 100 billion allocated, and then we only allocate 50 billion, and we have a large population. So we've answered that, all right? So we've answered that particular question. There was one question on the corporate individual income tax rates. I already asked you that. So is it realistic? I think the answer is not realistic, but we expect the Inland Revenue Board to really work hard for their money and actually try to squeeze as hard as they can and so on. So for corporates, just be prepared for audits, and documentation is key. And if you keep that documentation in place, I think you can face an audit, and the inner revenue may not recover in taxes. But honestly, if you've got a documentation in place, if we pay attention to the tax bill or the tax liability or the tax compliance obligations of a company, and you keep that in check, you'll be fine. I think challenges sometimes is that many do not pay as detailed and attention to the tax issues that they may face. So I think that's a question that we think we've answered from, I think, Hanif. The next, this was a question again, I think this from Gun. I think we've again answered that. It's how do we increase individual tax revenue if we are giving away more and more personal reliefs? Absolutely right, sir. That's exactly what we have been saying. But somehow the authorities seem to think they will, and that's the big question mark that hangs around that. One question on definition of a senior citizen. Is it above 60 years? I think so. A senior citizen would be 60 years and above. How much is the tax deduction for employing a senior citizen? Bernard, I think you had a slide which says there's an extension of that particular deduction, but this is a double deduction, right?
Yes, that's right. It's a double deduction. So for every dollar you pay, you can claim double. Correct.
So the double deduction, what salary you pay, you get another deduction for that. So you pay 60,000 a year, you get 120,000 deducted. So that's what we're doing. So that's clear. There's one question which is not a tax-related one on EPF. I will hazard a guess, and Bernard, you are welcome to add your piece. How secure is our EPF funds with huge EPF withdrawals and EPF proposing to sell assets to fund withdrawals? Honestly speaking, the EPF has a huge kitty. If you think of the total amount, investable amount that they have, huge amount. I think the recent hue and cry is about allowing withdrawals, right? For those who need it from their account, and including now account one. And the dilemma we have is you're looking at your retirement. Even under retirement, many people do not have enough money to draw out from the EPF. So that's the dilemma we have. And yet you have politicians and others pushing for allowing a withdrawal, which they have allowed. And then yesterday, I think EPF came out with something which allows a certain amount, percentage out of your amount, but they are saying that they will fund it initially from their available funds, and then the EPF contributors will top up later, pay back. It's not something that you take and then you don't, fill up your kitty again. That's a challenging thing. I think in the end of the day, I still think that there's a 12 billion that the EPF said they're putting aside to allow people to withdraw. I still think EPF is strong and EPF has got enough funds, but the issue will be if you utilize all this to allow people to withdraw, you have less to invest, and therefore you have less returns coming from the investable assets, and therefore be prepared for much lower dividends in some of the years to come. So that's probably my answer to this question. I think that's probably, you may agree with me, Bernard. If not, you have any comments?
Well,
maybe.
before the budget, this was one of the proposals I actually was quite supportive of. I think the B40 today, yes, they may not have sizable enough of EPF to be able to rely upon when they reach 55 or 60 years. I think EPF came up to say that's only about between 12 to 15% of their members today, if you look at the numbers. But it was quite a high amount in terms of what they expect to be substantial enough to do on a monthly withdrawal, which is about 900 ringgit post-retirement to be able to survive until the age of 70 or 75. But however, I think at the moment, it's more of survival, it's more of liquidity, and I guess EPF today, to sum a lot of the B40s, is their biggest bank account. And I think because over time that they have saved, say someone in their 40s, this actually is enough for them to make sure that they're able to survive 2021 year in these 2 years, to be able to make sure that at the end of the day, they have to be around at 60 to be able to enjoy it, the EPF. But getting past these 2 years with their family, I think this is the most important decision that they have to make. And I guess, and I'm still supportive of it, there is a restrictive amount in terms of how much you can withdraw, but I think the liberty and the choice should still be back at the contributors.
Yeah, agree. I think the issue at the end of the day is safety net for the vulnerable groups, right? And EPF is meant to be one of your safety nets. Besides that, other funds as well. But I think the challenge is utilization, and maybe we shouldn't be spending too much in terms of allocations to ministries. You can cut down certain things, channel it to a safety net kind of stuff, help the vulnerable groups, give them. And actually, the idea is not to keep helping them. The idea is to upskill them and actually retool and give them opportunities and have a focused approach, targeted assistance. And we talk about this, easy to mention all this. Economists will use all these terms, and so do I. But at the end of the day, it's not being converted into something tangible. And this is a challenge we have in the context of Malaysia. Value for money, cost-benefit analysis of everything that we do. Any allocation we make, funds we issue, who is getting it, how is it utilized, did it achieve the objective? So those are challenges. And this brings me to one idea that was mentioned. It's not a question, it's an idea. I think it's a good one from Rohani. Many earning more than 1 million gross income per annum. Yeah, most of them are in EY, I think. Yeah, Bernard? Sorry. So many of them earn a lot, and I agree. There's a segment, the T20. In fact, we pay almost at the high end, almost 25-30% average tax, and setting up a voluntary education fund from top scorers in exams who did not get a scholarship, have a voluntary fund. We contribute to that, and then you get a rebate from your personal tax for your contribution. And instead of going to private foundations, there's so many private foundations have limited funds and there are specific objectives, and that could be subject to abuse and so on. So have an officially managed fund. And so this person says, we'll be happy to move my earnings to such a fund, receive a rebate. I think that's an excellent idea. And the question is, who will set it up, who will run it, is important. And I think that's one of our ways in which we can contribute to try to help the young to get a good education so that they then develop themselves into solid professionals and earn a good living. I think that's a good idea. Now, then the next question is on how can we strike a balance? Okay, this is a philosophical question. How can we strike a balance between life and livelihood of people and moving forward, especially during the pandemic? So I think that we all understand. It's what the government is trying to do between churning the economy and making sure everybody has jobs and has something to dip into to fend for themselves. So I think we know that. Another comment came about civil servants. So
Brenda, wait.
Yeah.
I think there is the ICDM host would like to answer or contribute some of the questions there, is it?
Yeah, sure. Where is the...
I see on the Q&A.
Yeah. So
okay.
That's the one on life and livelihood, right?
Right.
And then during the challenging time, are there any flexibility in paying taxes, individual taxes, especially not only to those who are impacted by COVID-19? This is about installment plans, right? I don't think there are any for individuals. There was for businesses, companies under the COVID-19. There were, you had, I think, 3-month kind of extension, and you were allowed to also file in your tax returns a bit late. So that was more for businesses, because SMEs in terms of corporate entities and also those who are running probably a partnership and so on. So the question asked is, during the challenging time, is there any flexibility in paying taxes for individuals? And I think at the moment, I would say for individuals, not that I don't see any flexibility. You're paying your tax through your deduction from your salary that you get. So if you don't have, if you're out of a job, then there's no taxes to pay. If you have a job, then it's being deducted. I think perhaps the question asked is also about, is you still need, perhaps your salary has been cut, you need to dip into your savings, and perhaps can you give us a little bit of reprieve? So I think that's a possibility. But again, no measures were even announced with regard to individual taxes, even under the MCO. It was more for the businesses. So good idea, but one can always write in to ask the Inland Revenue Board for some discretion, but I doubt that you will get a positive response unless the government says yes. I don't know whether, Bernard, you have any other comments on that one? Good to have.
No, I think very much your point was focused on salaried employees, on business entrepreneurs, self-employed individuals. Yes. You can still go to Inland Revenue and ask for, in terms of structured payment, in terms of the installment scheme, if you have on any of the prior years, or even in the current ones, you can still talk to them. Actually, to be honest, Inland Revenue today is very much patient and considerate in terms of making the flexibility of installment payments for business enterprises and entrepreneurs. I don't think there's any flexibility at all for salaried employees at the moment.
Yeah, and that brings us to one more question that again is talking about the question at the top on our chat box is the range of tax incentives available for organizations. How can the private sector play their part in complementing the government's efforts in strengthening the economy? That is, creating more job opportunities, reskilling, revenue and product diversification, project investments, equity funding, etc. Now, I'll be very honest that in looking at a response from the private sector, it's up to the private sector, right? So the question is, how can the private sector help? The private sector is there fundamentally to generate profits for its survival, for its shareholders, for its owners. And then the question really is, all of us want to keep growing. And but we have issues in terms of demand and also supply, right? If those of us rely on exports went down, demand was not there, revenue falls, we then have difficulty sustaining cash flow and therefore paying our debts. Then the other question is, we also make products which rely on various others who also may have supply chain issues and unable to deliver, and therefore we have issues. So the question is really, for me, many of our private companies are not making losses. They are still making profits, maybe lower profits, obviously. Some I know have gone down by about 20-25% roughly in terms of its revenue, total revenue so far. So what should we do? I think we need to answer the question about what is really the objective of the private sector, right? Private sector should be looking at aspects of CSR as well, besides looking at profit making. And this is an area that we need to look at. we cannot create job opportunities if we don't see demand for our product picking up, right? And once it picks up, then that means we will see opportunity for more hiring. But perhaps what we should be looking at is and creativity. And Bernard, chip in if you have any comments. Creativity in terms of diversification, looking for opportunities during this pandemic. We saw many examples how many started making masks and so on, doing other things, trying to earn a living. And companies can also do the same. Some companies are also looking at areas in terms of how they can generate more revenue, new lines of business and so on. But really, there are not many that you can single out. But that's probably one of the ways. And then investment, once you identify a potential investment, then do you have the funds to put into that investment? You may look at bank borrowings and so on and so forth, depending on your risk appetite. And then, and also another opportunity for private sector is actually acquisitions during this particular time. Acquiring other types of businesses, an opportunity to now looking at the value, the PE ratios of some companies is low, and then it's a good opportunity to buy, and therefore that may create some interesting dynamics. So I think private sector has a role, but you see, many times the private sector waits for governments, a push from government, and before they react. And I think that's unfortunately how a Malaysian business community operates. So perhaps we can look at a situation of doing it on our own. And I think part of CSR is to help the nation. And therefore, creating job opportunities, perhaps through apprentice programs, helping people to learn, and then they go out and look for work and so on and so forth. Okay, let's move on. We are almost at about 5 minutes more, I think, for our thing. One more question. Actually, it's more suggestions, right, Bernard?
Yeah. I think just adding on to your point earlier, Dr. Rinder, right? We are at the moment, the Malaysian enterprises and everything, I still feel that we are still too much labor intensive focus in terms of the overall, the way we do our business and everything. The only way you can get out of it is, yes, through automation, digitalization, efficiency in terms of business operations that can be achieved through, more technology-based innovations. Yeah. That itself will not go on its own. Obviously, then the efficiency will come, obviously, hoping to result in higher, better profits, returns of margins and everything, which means that we in Malaysia as well, the people of Malaysia should also learn to upskill and reskill their experience and expertise. I mean, this is the best time to do it. The next 12 to 18 months is actually the best time to do it. Because otherwise, 5 years down the road, we'll still be back on the same discussion. Why are we still over-reliance on foreign workers, and all these discussions will still be there. So unless someone take the initiative from the corporate and supporting the individuals to learn this new skill to be there, and that learning new skill and everything is going to be more expensive. Yes, we're going to be paying more wages and salaries, but that hopefully will be able to offset through the efficiency and in terms of the better margin that they can get from this automation. So it's a whole circle thing. Yeah.
No, I agree. I think those in the private sector, corporates who are doing all right, perhaps this is the opportunity when a nation goes through some trials and tribulations, and you cannot expect the government to do everything for everyone. I think that's the reality. And we are not a welfare nation like most of the developed world and the most of the countries in the EU. Where the government will come in and help you. We can only do a little bit. The government can do a little bit. It's the private sector. We should be looking at investing in our young, investing in our workforce. In fact, even helping the senior citizens who are still able to work to retrain and so on. So there is a place for CSR work of that nature, but it means you are actually putting money towards really donations, spending the money and not really giving away donations to others, but you manage it and you make sure it delivers value. And I think that's the only way to do it. We tend to always forget about, well, young, the old, as long as they are able to work. The issue is there could be ways of retraining, and I agree with you. It's the gig economy, it's the shared economy, it's the digital world. So everybody now needs to get on board. And our challenge in Malaysia is to move towards becoming a digitalized economy. Look, the issue about education, how we find that year after year in our budgets, we spend money on fiberization, so-called digitalization. Every year we put, and yet we find that in places like Sabah and Sarawak, I mean, that we heard about in the newspapers, accessibility, bandwidth, ability to learn online, you know, for students is amazing. And that puts us into a bit of a bad light as well, because we seem to spend a lot on fiberization and getting, you know, Wi-Fi's enabled and all that stuff. And somehow I sometimes feel that it's all about not managing it well, and all about giving out contracts here and there rather than managing the implementation of it effectively. So I hope that's the digital economy. We need to capture that. Budget speeches make comments about all this, rightly so. But the challenge is that too many ministries involved in the same thing. And therefore, who is driving all this is a challenge. So I think we can talk a lot about civil service, about the cabinet, bloated and or otherwise. The important thing for us is delivery and making sure we get things delivered well. So that's the role of the government. Private sector can give it a push, can give ideas, can put money to say we'll fund this and hopefully make our society more resilient and therefore move in the right direction. Now, I am conscious about time, and I think we've answered all our questions. I just like to therefore take the opportunity, perhaps, of thanking Bernard, obviously, for sharing with us all his updates in terms of the latest developments. And I hope participants had some value in terms of some of the insights that both of us have managed to put across in this period of time allocated to us. And we'd like to thank ICDM as well for organizing this. And we thank you very much for your time. And I think over to you, to the MC to close this session. Thank you.
Thank you so much, Dr. Veer and Mr. Bennett on behalf of ICDM for such an insightful, engaging, and candid conversation, as well as to our audience for your challenging questions. I hope this shed some light into preparing ourselves for 2021 and where do we see ourselves heading to. If you're interested to attend more of our Power Talk, we'll be having a global series theme 2021 Refresh the Agenda that will start on 7th of December 2020, as well as two of our upcoming public programs, The Quiet Transformation of Corporate Governance by Eric Vermeulen on 3rd of December, and the role of audit committees in ensuring organizational integrity, risk and governance by Wee Hock Kee, Vincent Loh, and Alex Ui Kiampo on 7th to 10th of December. For more information on all our programs, do visit our website, www.icdm.com.my. And before we wrap up our Power Talk for today, we would like to you to provide your feedback on our Power Talk by scanning the QR code on the screen. And we hope you have a great evening. Thank you again for everyone who are attending.